Welcome to Money and Markets, Series 5, Lesson 9. For most of this series, we have treated financial decisions as purely economic. Risk, return, price. But in recent decades, a new dimension has entered the conversation. How companies behave in the world. Environmental impact. Social responsibility. Corporate governance. This is ESG investing, and it has moved from a niche idea to a multi-trillion-dollar force in asset management. This lesson is about what ESG actually means, why it became mainstream, and what the evidence says about whether it delivers. Imagine two coal power plants. Same size, same fuel consumption, same electricity output. One earns an ESG score of 82 out of 100. The other earns 41. The difference? One company publishes detailed data on emissions, community impact, and board composition. The other discloses almost nothing. Same real-world impact, different scores. This gap between what ESG measures and what actually happens in the world is the central tension at the heart of responsible investing. ESG stands for Environmental, Social, and Governance. It is a framework for evaluating corporate behavior beyond financial performance. In the past decade, it has become one of the most discussed and most misunderstood ideas in finance. ESG is three separate lenses for evaluating a company. Environmental. How does the company affect the natural world? Carbon emissions, water use, waste. Social. How does the company treat people inside and outside its walls? Workers, communities, customers. Governance. How is the company structured and controlled? Board composition, executive pay, auditor independence. ESG scores are produced by specialized rating agencies like MSCI, Sustainalytics, and S&P Global. They collect data from corporate reports, government databases, and news. But here is the problem. Different agencies, analyzing the same company, regularly produce dramatically different scores. The correlation between major ESG raters is about 0.5 out of 1. Credit ratings from competing agencies agree about 0.9 of the time. ESG scores are not objective measurements. They are judgments. Environmental factors measure how a company interacts with the physical world. Carbon emissions, both from direct operations and from the supply chain. A car manufacturer's direct emissions include its factories. Supply chain emissions include those generated when customers drive the cars. Water use. In water-stressed regions, industrial water consumption is a genuine material risk. Waste generation and disposal. Land pollution and toxic materials create legal liability and community relations problems. Energy efficiency. What percentage of operations run on renewable energy? The challenge: data quality. Many companies, especially smaller ones and those in developing markets, do not yet measure or disclose this information consistently. You cannot score what you cannot measure. Social factors examine relationships. With employees, are workers paid fairly? What are injury rates and turnover? Does the company provide benefits and career development? With suppliers, does the supply chain use forced labor or child labor? Are contractors treated with basic dignity? With communities, does the company support local economic development or extract value and leave? With customers, does the company handle personal data responsibly? Does it market honestly? Social metrics are the hardest to quantify. What one investor views as adequate supply chain oversight may fall far short of another standard. What is agreed upon? Companies with poor social scores tend to face more regulatory risk, labor disruptions, and reputational damage. The link is not always immediate, but it is real. Governance is the oldest and most financially material component of ESG. It asks, Who controls the company, and are their interests aligned with shareholders? Board independence. Are the majority of directors genuinely independent from management? An insider-dominated board is less likely to hold management accountable. Executive compensation. Is pay linked to long-term performance? Or do stock options encourage short-term stock price manipulation? Auditor independence. Has the same audit firm served the company for decades? Long relationships can become comfortable rather than critical. Companies with weak governance blow up more often. Enron, Wirecard, FTX, these were all governance failures long before they became financial failures. The problems were visible in governance data for those who looked. If you look up the ESG score for a major company using two different rating agencies, you will often get very different numbers. Tesla has been scored near the top of some ESG ratings and near the bottom of others. Same company, same year. Why? Because agencies weigh factors differently. One values carbon intensity heavily, another weights worker safety, a third prioritizes governance. Because they measure differently. A company discloses emissions in one format. Agency A can use it. Agency B requires a different format and marks it missing. Because they disagree on what is material. Governance problems at a financial firm may be highly significant. The same problems at a small retailer may be minor. Investors who rely on ESG scores without understanding the methodology behind them are making decisions they cannot fully trace. Greenwashing is the gap between what companies say about sustainability and what they actually do. In its most obvious form, a company announces a net zero pledge for 2050, with no concrete plan for the next 5 years. In subtler forms, a product is marketed as green because one input is recycled, while the rest of the supply chain continues unchanged. Greenwashing exists because the benefits of appearing sustainable are high, better ESG scores, better press, lower borrowing costs from green-labeled bonds, while enforcement for misleading claims has historically been weak. That is changing. The U.S. Securities and Exchange Commission and European regulators have been issuing new rules requiring companies to back up climate claims with data. In 2023, the SEC proposed rules requiring public companies to disclose climate risks and greenhouse gas emissions in their financial filings. The honest answer on whether ESG portfolios outperform. The evidence is genuinely mixed. Studies from the 2010s found that high ESG portfolios outperformed. But much of that outperformance came from a single factor: ESG-rated companies had less exposure to energy stocks, which underperformed during the oil crash and the clean energy boom. When energy prices reversed in 2022, ESG funds that had avoided fossil fuels significantly underperformed the market. The theory for why ESG should outperform is not obviously wrong. Companies with strong governance blow up less. Companies managing environmental risk face fewer regulatory surprises. But none of these benefits are guaranteed, and markets may already have priced them in. The sounder argument for ESG is not outperformance. It is risk management and alignment of values. ESG stands for environmental, social, and governance, three lenses for evaluating companies beyond financial results alone. E. Environmental impact, carbon emissions, water use, waste generation. S. Social relations, workers, suppliers, communities, customers. G. Governance quality, board independence, compensation design, auditor oversight. ESG scores from different agencies disagree significantly. A correlation of 0.5 between raters means these are judgments, not measurements. Understanding the methodology behind any score is essential. Greenwashing is real and growing. Regulators in the EU and US are moving toward mandatory standardized disclosure. The performance evidence is mixed. ESG may reduce certain risks but does not guarantee outperformance. In our final lesson, we gather everything we have built and look at what comes next.